Hi, thank you so much for that. Hi everyone, good afternoon. I'm Anisha Jain and thank you so much for wading through the BKC traffic and making it here to the Global FinTech Fest. Call me a bit biased, but I think we have one of the most interesting and hot topic of conversations right now. And I think it was only in the infinite wisdom of the GFF organizers who probably saw it coming and kept this topic even before that monumental date of 16th August 2024, which I'm sure none of my panelists here will forget for a long time to come. Um, and I'm making light of an important topic here, but that date reminds me of that meme of the Pakistani cricket fan who just said, "Pal mein duniya badal gayi and zindagi badal gayi." I think it was one of those moments for some of these guys. But I think we have a lot to unpeel and lots to discuss in terms of the way forward. So let's just get started. I have a very passionate group of founders with me, as they always come. Of course, Achal from Liquiloans, Neha from India P2P, and Bhavin from LenDen Club. Thank you, everyone, for joining us today. Just to set the context first and understand, the discussion point that we have today, which is building trust and transparency in the India P2P lending system, I wanted to begin by asking you, Neha, put the data into context for us. The size of the industry, what's been the overall number of people impacted, what's the default rate or the average rate of return, etc.
Yes, so Anisha, thank you first of all for moderating this session. Just to give a very quick context of where P2P lending stands now, it's a relatively new sector. It is a sector that has been regulated since 2017, and sometimes there is a little bit of comparison that people, the audience tends to make with other products, which might be regulated, not regulated. This is a category of non-banking financial companies, NBFC P2P. And for anybody, for all of us to be here, all of us as individuals and companies to be here, we have gone through a regulatory check process, which is where the regulator has said that, okay, we find you capable and able to run a peer-to-peer lending platform. And 2017 is when the regulations, first set of regulations came in. Since then, the regulations have evolved, and this is one big change. And our little bit of, not little, but a big grip with that change is that it's a very sudden change, but we'll discuss more on that. But the industry kind of took off post-COVID. COVID was a hard time for the P2P lending sector. And in fact, P2P lenders, we were not active then, but my colleagues here and others were active then, were the only kind of lifelines, lending lifelines during COVID. They were the most resilient lenders during COVID, which is telling something. And now the industry is close to 10,000 crores in AUM with 10 to 15 lakh active lenders across various platforms. There aren't too many, and one of the reasons that there aren't too many platforms is that it's a very hard business to start. It's a two-sided platform where you kind of have to do almost instantaneous matchmaking. So you need the flywheel running on both counts and integrated in between. It's a hard business to start and execute. And over the years, the industry sector has delivered, 10 to 12% in returns with about 3 to 4% of defaults. And speaking of borrowers, like personally from at least India P2P side, we started because we felt for a certain borrower segment. And the reason to start India P2P was to get more capital access to that particular borrower segment or asset class, which is women, small business owners. But having said that, this is also a sector where compared to most fintech lenders and other lenders, the lending rates and APRs are actually a lot lower. So this is a sector where, contrary to sometimes popular opinion that, somebody who doesn't get a loan on any other platform comes to a P2P lender, it's actually quite the other way around. Yes, because you can, do a very quick analysis of APRs across P2P lending platforms versus traditional NBFC lenders and fintech lenders, and we'll be lower. So in that sense, it's a great platform product to have. It's gone through a little bit of again, little bit is an understatement, upheaval on August 16, and yeah, But how we tide over it and what we expect should happen, we're all here to talk about it.
I have little different opinion over here. Let me redefine P2P lending industry in India. It is an industry which has 9 to 10,000 crore AUM as on date, lend 25 to 30,000 crore rupees to around 80 lakh unique borrowers across India, and we have touched around 2.5 crore lives in the country, which is approximately 1.5 crore, 1.5% of Indian population. And that is what the strength of P2P lending, and that is why we are standing today after crossing two big crises: one, demonetization; second, COVID in 2020 and 21. So while we are discussing this topic today about the trust has been created among our users, among our stakeholders, and with the regulator probably, is because we have demonstrated very phenomenal results out of the platforms which are created and regularized in 2017. So I think so far the work has been phenomenal. Probably across the industry we are right now talking about there is a little impact or there is very high impact of the regulatory changes, but let me tell you, I have been part of NBFC industry and all such kind of storm comes every 4 or 5 years. Immediate reaction is always like, oh, world is over, but probably world never is over. You always find a different ways to live in this world, and that is how we survive, thrive, and grow the industries and build new industries. So I believe that the kind of trust we have built among our customers, specifically lenders and borrowers, keeps motivating us that find some new solutions for us, because we will get money probably only from you guys, and there are no other avenues available in this market to lend the capital which we are getting from you. And probably that is a motivation will keep this industry thriving, and possibly in next 5 to 10 years will be at the next level. I'm just reminding one sentence which PM Modi said in the morning today, that 5 years down the line, I will again visit GFF and I'll be talking to you guys, and that time you will realize from where you have reached to where. And that is the kind of industry we are envisaging in terms of P2P lending also.
Okay, yeah, absolutely. And clearly you're getting a thumping response for that. But the fact, Bhavin, that you're a 10,000 crore industry, obviously you will see a lot of regulation as well. And I think that's why we saw that kind of, regulation come by from the RBI as well. But I think at the first step, it's you who reached out to the RBI that you guys want to be regulated in the first place?
Yeah, so when, so we started in 2015, couple of platforms started in 2013-14, and the idea was in India, if you are regulated, probably you will be able to create better trust among the users, among all the stakeholders. That's the reason we reached out, we started liaising with the regulator, and then ultimately we got regulations in 2017. So that was a brief history behind it.
Interesting. But since we are talking about the data, Achal, I wanted to get a sense from you regarding the default rates. And I won't call it distrust, but there's a bit of a disbelief in the system as to how this high-risk product of yours, and you can clarify if you want, is still at the default rates of just 3 to 4% versus, let's say, MFI and others who are right now at a much higher NPA level. What explains that? Is there any slicing or dicing of data? Is there a definition which is different of default for you guys?
Thanks, Anisha. See, we usually cater to retail loans, right, which is probably the safest segment across all asset classes. For banks, they lend to corporates, they lend to SMEs and retail. Retail for them also is one of the safest segments, and look, we are no different. For a lender, their money is diversified across thousands of retail lenders, and unlike corporate loans, and it's a very, very important matrix, right? For corporates and SMEs, they pay the loan through their bottom line, right? For individuals, most of the loans are paid through their salaries, which is the top line, right? So we are actually capturing their income and not the profit which is left after the expenses, and that's why the low default rates. And this is further koshered because look, the lenders' investment is spread across multiple loans, which kind of diversifies their risk, and hence they are getting stable returns with little volatility.
Fair enough, I'll come to that. But Bhavin, there seems to be a bit of a issue regarding the way you're marketing the product as well. And I went through some of your websites as well. You guys talk about how invest with us or diversify your portfolio through us, which gives it a bit of a sense of an investment product rather than the lending product. And that's one of the red flags that RBI too raised. Would you concur with the view that there is a bit of a misselling here or maybe mispositioning of the product?
I don't think so, because if you look at the first set of regulation which were announced by the regulator in 2017, that itself had lot many invest related words, investor, invest, invested. So we took it up from there. Now they have suggested that it should be marketed as a lending product. So I think industry will align with that.
And Anisha, just to add on to this, right, investor and lender are, there's a thin line in my view, and they're overlapping kind of statements, and you may sometimes just use it a little, or tend to use it a little loosely, right? So for all practical purposes, right, everyone knows what the product is. You're giving money to the borrower. So to that extent, I think it's fine. But of course, see, it's an evolving industry. The rules of the game are evolving, right? So we also, as regulated entities, tend to take inputs from the regulator, from our various stakeholders, and obviously, kind of as an industry, we kind of keep on improvising upon the advertising marketing. And one of the goals of the association of P2P was to kind of standardize that marketing across all P2P players.
And Anisha, just pitching in here, I don't think RBI has been this strict about whether it should be investor or lender. Most of us have actually copied content which is in the RBI directions onto our websites and so, and there is a reference to participants as investors.
Yeah, no, the only red flag there is if you're going to use it very loosely, perhaps you should be regulated by SEBI too, because if that's an investment product, they should be regulating you too. So I don't know whether you want to go down that road or not, but since you talked about...
I think I would not agree to two words.
Sure.
Either of them can regulate it, but if you have two
Both?
regulators for the same product, then it becomes very difficult situation.
Yeah, so that's why you have to be very careful whether you're being a lender or an investment product. But coming back to the point that you were raising about standardizing the disclosure material, and that again is a bit of a dichotomy per se, because I went through the websites of each of you, and probably you guys can kind of try it too. The disclosures regarding the performance of your portfolio is not standard at all. Somebody is giving a chart which is of a time period, somebody is just putting a table, somebody is giving a very detailed information about what the geographic breakup is and what is the kind of renewal, etc. What are you doing to improve that, or would you say that there was a bit of a gap there in your understanding and that could have been done better? Either of you can take that.
So we really want to make it very standardized and ensure that each and every person coming to the platform understands it well. The problem is different platform works in a different way. Different product team thinks in a different way how customer will perceive that particular information, right? And based on their understanding about their customer base, they will have a different way to present it. I think now with this new set of regulations, RBI has tried to give little bit more clarity around what kind of information should be shared. And we believe that the regulator is the father figure here, and we all are kids. Whatever direction they will set and they will standardize things, we will follow it in a better way. Again, this is a evolving industry. So let's say if we talk about mutual funds 15 years back, that time so many things were undefined, which got defined over the period of last 15 years. Still, there will be a lot of things which is today also not defined in a right way. Probably that will get defined in next 2-5 years. But if mutual fund took it 20-25 years to set it up in a right way, then we are just 8-10 years old. We still have many years to go.
So you haven't reached that angry teen age yet. You're still in the nascent and the infant stage.
We are still toddlers.
Yeah, so you're still following what your parents and godfather is saying. So that's interesting. But Neha, just kind of building on that point, and I think I was again going through some of the reviews, etc., and there seems to be a bit of a disconnect in terms of the information which is provided. And I'm just trying to understand here, for the lender point of view, how are you making sure that you're putting the borrower's information right out there in terms of the credit assessment, in terms of what is the use of those funds? How are you ensuring that that's been done in a very transparent way on your platform?
So Anisha, I can speak a little bit on behalf of everybody here, and the examples I cite would be specific to us. So all the borrower information is always in the system because you're underwriting each and every borrower. And I think across platforms, the approval rates would be, 20, 30% at best. So you're actually rejecting more borrowers, way more many borrowers than you're accepting onto the platform. And subsequently, all of this information is made available to lenders who come onto the platform. Now, from what happens from a practical point of view is that, let's say I'm investing or lending a lakh of rupees. Now, I would ideally want to, and it's very easy with technology to kind of diversify that capital over, let's say, 100 borrowers, which is something everybody would like to do. And if I am a lender, realistically, I'm not going to go and try to evaluate each and every borrower. And on top of that, just look at it from a little bit more practical point of view. Even any debt product you invest in, you really can't underwrite beyond, like, let's say if it's a bond or something, let's say the rating is so and so, you can do diligence up to a certain level, but you cannot go down to the level of diligence that maybe a ratings agency or somebody else has done to arrive at that overall figure. So across all platforms, we've been very transparently sharing that. Most lenders tend to ignore it, which is something that we'll work on to ensure that they don't ignore it. They don't just, skip that information. And I can speak on, from our point of view, we, share what the borrower-wise performance is. And people are like, बहुत scroll करना पड़ता है, नीचे वाला दिखा दो. And we say, okay, it's, a few seconds of scrolling, you can do that. But all of this is there. There is no, black box in between as to where capital is going. There is no leverage. There is no corporate balance sheet in which you can, pretty much everybody is doing retail loans. There is no corporate balance sheet on which you know how to, this guy's net worth or this or that. I mean, you can't do any of that creativity here. So I do want to definitely say that the August 16 changes that have come have not really blamed any set of platforms for, not, just being a black box, so to say. I don't think that has been the case.
And Anisha, the end beneficiary of this transparency is the lenders, right? And we have served millions and millions of lenders with hardly any complaints about transparency just yet. And it also needs to be understood that most of us are sourcing lenders, how mutual funds were sourcing investors a decade back is through wealth management firms, right? And they tend to ask a lot many questions than retail lender would, right? And it's much, much deeper than you or I can probably anticipate or even expect. So to that extent, probably we have not done a good job in marketing the transparency which we are displaying, right? But on ground, there's a lot of work which is being done to kind of make sure that the lenders get access to that information. Whether there is room for improvement, of course, yeah, there is room for improvement, there is room for standardization and all, but no one is intentionally not being transparent because these are stellar numbers, right? 2 to 3% NPA over last 7 years, kind of being resilient during the times of COVID, etc., is a testimony to how industry has been able to kind of perform in last 7 years.
Yeah, I think that's the problem with some. It's too good to be true, but it is true is what you're saying. But the automatic mapping versus the manual mapping, and that is what you mentioned earlier as well, Achal. So throw more light on that. What is the reality of the implementation of that? And I was just talking to one of the experts, and he was saying that you guys are going to become the Tinder of loans because you'll be swiping right or left and kind of mapping the loans from here on. But what's the reality of that? Because, and correct me if I'm wrong here, I understand that the total limit for an individual or person to lend is 50 lakh rupees, and the maximum that they can do to a borrower is 50,000. That means I'll have to go to 100 borrowers and vouch through their credit assessment, etc. As in, how would that work?
So we are trying to figure out on how it will work, right? Look, the regulator's intention might be very, very noble, where they would want the lender to exactly know the kind of borrower they are picking, right? But I can tell it for a fact. We have people who have been doing credit assessment for 10, 15 years, and they might not get it properly right? And look, we've also got getting the dual responsibility of being a collection platform along with the tech platform, right? So a lender might pick up a borrower with the expectation of 20% return, but if the money does not come on time, they'll blame the platform for it, for not collecting properly or not doing the thorough due diligence. So in my mind, at least, the auto lend to that extent is beautiful because it's easier to kind of slice and dice borrowers. At the same time, the lender is in complete control of the cuts he wants while selecting the borrower. So probably we'll have to wait and watch how the industry evolves. Look, probably the regulator is also learning few things along as the industry progresses, and I hope they are kind of flexible with the feedback, with what the players give, with what the other stakeholders give, right? So let's see how it happens.
Yeah, Bhavin, and just to add on to that, do you think this will take the tech out of the fintech because you won't be able to do the automatic mapping anymore, you'll have to do the manual mapping? And also just help me understand, right now, was that option given to the lenders that they can either go for manual mapping if they want or the automatic lending? Because if that's the case, what's the problem here?
Yeah, so what I understand from the regulator's concern in terms of transparency is he should be in the complete control of what borrower a lender wants to choose. If that is given in terms of both the choices are given and he picks up one out of that or maybe both. So on our platform, we have seen that thousands of lender goes for both the options. He will try some amount through the auto lending. He will try some amount from manual lending. And see, while industry has been there for 9-10 years now, we have seen pros and cons of both the sides, right? And that is how the product evolves over the period of time. So probably if I look at the dilemma of lender, possibly from his perspective, he is expecting us to work in a fashion like what mutual fund does. That's a basket of loans he will get and he will get some returns out of that. From the regulator's perspective, they expect us to become a NSE or BSE kind of platform where there are loans are kind of a stock, investors are coming and they are transacting, buying and selling the stock. So I think we are right now in the phase where we are trying to balance both the sides, and possibly in next couple of years the balancing part shall be over, hopefully, and then probably the clarity will be there in terms of regulation, clarity will be there in terms of perspective of the investors as well. But today it is definitely there. As far as both the products are concerned, both has its own good part as well as bad part. And I think pre-COVID era, manual lending was very prevalent option among many platforms. So I do not think that it is a bad product. I give you one example as well. Some 3-4 years, 2019, I met one lender based in Chennai. So he had 3 family members account on our platform, and his father will sit every day morning on all the accounts, pick and choose every loan. Okay, so see, as far as regulators' vision is concerned, I think that part is also good. As far as technology is concerned, the other part is good. So somewhere it has to come in balance, which time will only tell how it happens.
Okay, but right now what the situation is, are you keeping both the options open or it has to be only manual?
I think that
Is what the
interpretation is
at
open
least for the interim.
as
Oh,
far
as
as the
it's-
current set of regulations are concerned. Now it is up to platforms how to interpret and use it.
Okay, that's interesting. The other bit of information I wanted to discuss, and again, this is coming from the lender's point of view, Neha, is it seems like that the regulation is not going to allow early withdrawal for lenders. Do you think this will just amplify the level of distrust or open the room? Because right now you had the ease to take it out anytime you want, and this will actually create a bit of a black box. And as a lender, if I was a lender, I wouldn't be very, very conveniently putting money into it, thinking, I don't know whether I can take it out or not when I want it.
So Anisha, that is a serious concern, and it comes a little bit from the point of view of natural justice as well, that if I've made an investment, I should have, as a citizen, it's my constitutional right to, sell that off to or will it off to my child or whatever it might be. So that was the understanding across all platforms, that we can facilitate you to exit your asset as partially, fully, as in when you need it. That kind of concept of natural justice still remains. Now, as platforms, we are not permitted to do it, but lenders can go find a third-party avenue to
But
still
do you
get that
think there could
service.
be one of the reasons of RBI to do it because there was perhaps some sort of evergreening or a quasi ARC kind of setup? Is that something you would kind of concur
Anisha,
with?
that I'd strongly protest to, because I don't think we are regulated entities. 100% of our data, not just directly from us, but from some of our partners, trustees, etc., is uploaded to RBI and just filtered, scrutinized, just pretty much all the time. So if there is any instance of evergreening, it is most easily spotted on a P2P platform or something like that. It is actually most easily found out on a P2P platform. 100% of our data is digital. I mean, most of us come from NBFC backgrounds where you have some cash, some non-digital, some physical applications. There is absolutely no instance there. So definitely this, this new rule that, or new interpretation or the new guideline that you cannot do secondary exits is new, but it definitely does not stem from
No
any
complaints or no findings of evergreening or quasi ARC behavior ever?
So see, we are constantly regulated entities. It's not like the RBI comes every 2 years and does a scrutiny. They look at us every month.
And just to add on to Neha's point, Anisha, right? See, liquidity and early withdrawals or secondary market are prevalent across all asset classes, whether it's real estate, equity, NCDs, bonds, etc. Right? This not being available to P2P lenders is a big roadblock. But I hope the regulator takes cognizance of it probably a year down the line or 1.5 years down the line when they probably see the sector stabilizing and open some of these features. And again, I've been repeatedly getting this notion that the P2P is probably too good to be true or the returns are constant. Let me kind of address that question once again, right? So, what does mutual fund do? They give loans to corporates, right? Most of the AAA rated, A-rated corporates borrow at 8 to 9% because it's a bulk wholesale loan, hundreds and hundreds of crores. And why is retail loan, though it's safer, more expensive is because of the ticket size, right? So technology is exactly playing that role where they can kind of remove that cost of operations and still make the loan accessible, probably not at 8 to 9%, but probably at 15, 16%. And that's where the arbitrage for P2P lenders come, where probably instead of earning 6 to 7% in mutual funds, they have the capability to earn 9 to 10% through by way of retail loans. So the P2P was a beautiful channel, right, of a kind of lending, or is still a beautiful channel, right? Right?
Yes.
Sorry, it is a beautiful channel, right? So where lenders can sustainably earn 9 to 10% returns, net of 3 to 4% default, because the technology, if allowed to be used in the way it is, right, can actually give those sustainable returns to the lenders.
Yeah, Anisha, I'll just give a very small example to kind of elaborate or just close out what Achal is saying. Let's say what happens with smaller ticket loans, let's say up to ₹1 lakh. Now, no bank wants to give out a 50,000, ₹1 lakh loan, even though the borrower's CIBIL is great. Like across our platform, sometimes I see borrowers jinka CIBIL mere se zyada, meko lagta hai kya kar rahe hain, what are we doing? But any which way, banks don't want to give out these small loans because their cost of processing this loan is going to be ₹8,000, manpower, branch, whatever, all that included. So banks, but want access to these loans, which is why you see so much of, frenzy to get your priority sector lending targets met, etc., etc. Now, banks typically lend capital to NBFCs. NBFCs further lend it to a smaller NBFC and then finally to the borrower. And now, because of the 1:5x leverage that we have in India, an NBFC cannot borrow capital from a bank at 10% and lend it onwards at 12% or 10%. It will necessarily lend it onwards at a minimum of 15%, a 5% NIMS right there, because you have cost of equity, you have cost of provisioning, you have the cost of managing just this transaction. And the beauty of P2P lending is that we are arguing for the point that this act of taking money from one lender and giving it to another lender does not merit 5-7% spread. And this is where P2P lenders with technology just completely eliminate this, disintermediate this value chain. And your higher returns are not coming up because of going after higher risk borrowers. It is actually coming because of this disintermediation.
So I was just trying to avoid getting into this point because we don't promote secondary market on our platform, but frankly speaking, across the world, there are so many developed market where the secondary market is a very open market practices. So I would say the future approach could be there are certain kind of guardrails are set around how can be operated, is platform allowed to operate or some third party can operate that. That could be the best way to go around this point. However, as far as the right is concerned, or if the instrument has to become a more viable or acceptable among the lenders, possibly this route has to be added over the period of time.
Fair point there. I wanted to shift focus right now and talk about the confidence from the lender's point of view again, but talk about the loss sharing bit, because again, the RBI has said that you can't provide any sort of notion of loss sharing, whether in terms of giving away discounts or kind of meeting it through your spreads. That's actually a bit counterintuitive, right? Because as a lender, I would be happy if you guys are paying it from your profits. I mean, how do you see that actually turning out to be?
I don't think that's a counterintuitive.
Okay.
If you look at the exchange model, exchange has to act like a neutral body. Whatever fees you want to charge, you have to be very upfront. Whether higher or lower, that's a second point. But you cannot take participation in the loss or the profit.
Were you guys doing it of late?
We were doing it, right? And I would disagree with Bhavin to a certain extent. See, it has to be noted that we are just not an exchange, right? We are also a collection agent. RBI, unlike a BSE and NSE, has given us a very important role of collecting money, unlike any exchanges, right? And most of the exchange collection agencies work on an efficiency model, right? And we also have to outsource collections to agencies which work on collection sharing model. Like if you collect 100 rupees, 10 rupees or 15% of that collections has to go to a collection agent. Now, imagine Anisha, right? If we were to kind of differentiate the fees for a lender, ki collection ka main itna lunga, exchange ka itna lunga, it's kind of difficult for the lender to understand. And second, of course, the guidelines now are very, very clear, and
it would serve the purpose of full disclosure if you provide that. What's wrong in that?
Yeah. So now, of course, the guidelines are very clear that you can't kind of forego your spread, which is, by the way, good for us as an exchange, right? Where there is limited incentive for us to be very, very aggressive in collections, because look, we are working just as a broker now and not as a full collection agent. But my understanding initially, or at least most of the players in the industry's understanding initially, was that you can't park your equity money, right, to kind of protect the lender. But of course, you can work on a collection efficiency model where, say for example, the portfolio's underlying IRR is 20%, right? Out of that 20%, it is a bilateral arrangement between the lender and the exchange or the platform to charge fees in a particular method. Now, there is complete transparency in terms of the methodology, but obviously since the amount is dependent on the performance, you can't just quantify the upfront amount, right? So the regulator had a problem probably with that, where they wanted an upfront disclosure, just like how it's happening with respect to borrowers. They wanted a complete fact sheet where the borrower has to know upfront the IRR, etc. Similarly, that would have been the thought process with respect to lenders also, where they should know how much is the platform earning upfront. Now, of course, this is a bitter pill for us to swallow, but the good thing is, at least, is that there is complete clarity in terms of guidelines. Whether that's good for the platform or the stakeholders, time will tell.
So just to summarize in maybe a couple of sentences, is the model which Achal explained, I think that built confidence in the mind of investors. The model which has now come up to the industry and which should be followed as an exchange, probably build much higher trust in the mind of investors going forward. That's what I understand.
But just coming to the point of collection that Achal was also talking about, that entire fund transfer mechanism, that has again been questioned for you guys, and there's going to be this T+1, because it seemed like you guys are acting as deposit-taking NBFCs when you can't be one. I understand this entire, escrow being there and all of that, but what would be your reply to that if somebody is saying that you're acting as a deposit-taking NBFC because you're not mapping it in any definite time of period?
But Anisha, we are mapping it on a definite time period.
So then what's the lapse with respect to the fund transfer? Because then why are you guys complaining about the T+1 then?
So the T+1 basically says that as a lender, I put in my money today. I can put in my money at 11:59 p.m. And if I don't come onto the platform and select and approve a list of borrowers or do whatever else activity I need to do, the platform needs to return that capital the next day, T+1. And there's no market hours concept also here. आप रात को
It's not T+1 working day, by the way.
Yeah, it's not T+1 working day, and there is no. It's not like money is coming in only till 3:30 p.m. or something like that. None of that as well, and we are not in control of the lender's capital. It is not coming into a current account where I can, Bhavin can do an NEFT transaction. None of us can do that. The money goes to an. And the escrow is managed by a trustee. We only interact with the trustee. Trustee sometimes takes all holidays, at least in one of the trustees does. And it's a great job to have if there was one.
But trustee's job was to probably regulate the wholesale lending NCDs.
500 crores, 20,000 crores. Now they'll have to, select transactions which are 5 rupees, 10 rupees. So there is a lot of resistance from the trustees on this. And again, the capital is never under our control. We only interact with the trustee to move the money.
And the trustee is sitting right here. So probably you can ask them that, see, 5 rupees, 10 rupees to probably approve and disburse on T+1 day basis does not make a lot of sense, right?
So if regulator is hearing you, and let's hope they are, what would work? T+3, T+5, 3+15? Come up with a
I think it should
suggestion.
be at least T+5 working days, so that lender who is bringing capital to the platform gets enough time to choose the borrowers. At the same time, when money is coming back, we as a platform gets enough time to reconcile, audit the numbers, return to the borrower in case of extra repayment, or send it to the lender. So T+5 should be practical. Second thing, in India today also, so many payment gateways still work on T+3 basis. When payment gateways are allowed to work on T+3, T+2 basis, what has P2P lenders done?
You tell us.
They should be allowed reasonable timeline, and that's why I think that's a common industry voice, that T+1 is very harsh point.
Even for stockbrokers, there's a quarterly settlement, right? Undeployed funds are probably settled end of quarter. Not that I'm sure, probably you can correct me, right? So I was like joking with my co-founder, right? We have a lot of well-wishers in the industry, right? So if anyone has to screw with us, they can just put the money in the escrow and probably wait for it to be deployed. If it's undeployed, you're automatically within the rules of violation.
That does give me good ideas.
And it's a lot of times people would, even this happens now also, people will just put in money sometimes into the escrow. We can't stop it. We can't stop you from putting money into the escrow.
You think you'll have to come up with some working hours kind of phenomenon, saying that you're only going to accept it till 5 p.m. and nothing after that. I don't know. I'm just kind of throwing an idea there. I don't know exactly how it will work, as you guys are figuring it out as well.
It would happen, and as we are discussing internally at the P2P Lending Association level also, there are more point of views are coming in. And possibly, see, when there are real practical problems, regulator also understands it and address it in a proper way. Probably that's the reason this was the only point where they had mentioned about 90 days timeline. All right, so we are always hopeful about good changes in the regulations, and we'll try to liaise, and you can raise a voice on behalf of us.
And right now we are expected to operate like India's best payments companies, fastest.
Which you are, right? Aren't you, kind of calling it to be that we are the best industry and we'll be...
We are, I mean, this is an industry which gives genuine value-add related arbitrage. This is not, this is a very unique arbitrage that P2P lending as a segment has.
But probably if we are able to crack this T+1, possibly we can be real good payment gateways.
Exactly, that's true.
Let's hope that 90-day timeline is utilized well by you guys and the regulator to think through this one. But from the borrower's point of view now, and you're talking about the role you're playing in collection, but there has been allegations that there has been coercive collections as well. There hasn't been full disclosure with respect to the late payment fees or the other charges that they are liable to pay. How are you ensuring that you're being transparent to the borrowers as well as to what could be the liability? Because of course there's no collateral here.
Sure. So Anisha, just two things here, right? we are one of the few industries which is kind of bringing some of the uh, uh, unbanked customers into formal financing channel, right? And we've actually kind of seen that we're giving.
I think there you guys will have to make up your mind, because she just said there are people who are with very high CIBIL scores that are coming in, and there are people who are
So
unbanked.
what makes you to believe that unbanked people have low credit score?
Okay,
Yeah,
fair enough.
right. So
Wouldn't they not have history
they are
enough?
not given an opportunity, right? And that's where the P2P kind of gives them an opportunity to kind of being in the formal channel of finance. See, no one wants to give loans to borrowers with bad credit scores, but obviously people with new to credit history, right? If they are being brought into a formal financing channel, why not, right? So these are the guys which were erstwhile borrowing at probably much higher returns from informal money lenders or loan sharks, which much more coercive methods. Here we are in an industry which is probably regulated by RBI, and RBI takes very strict cognizance of any coercive methods to kind of recover the money, right? So and every borrower has a grievance readdressal mechanism, and RBI is leaving no stone unturned through some of the best brand ambassadors to kind of make sure that we are being penalized for any wrong actions that we do, right? And also the digital lending guidelines which came back in 2020 are a game changer, right? Where every regulated platform has to be very upfront with the disclosures they are making in terms of the rate of interest which they are charging, kind of combining processing fees plus the underlying IRR into a proper annualized percentage rate, what they call as APR. So it's very difficult to kind of say that we are charging hidden charges or mis-selling products, right? We are not even allowed to sell anything apart from loans, and kind of the banks and all may be selling mutual funds or life insurances without a license. P2P technically can't even do that. And with respect to coercive methods, yeah, so everyone has that access to the CPC, the Consumer Education Protection Cell, to kind of raise their grievances.
Interesting one. So we've talked from the borrowers and lenders' point of view. So Bhavin, let me come to the investors' side. What's been the feedback of investors? Because I come from a stock market background, and I know that regulatory overhang is a big red flag when people are investing, because you never know how things are going to turn up, and that's what happened on 16th August. So far, what kind of feedback you've got? Because building trust and transparency is also important from the investor point of view.
So I just want to raise one point here is, see, 16th August was not 16th December kind of event when something very major happened at the country level and suddenly the economy has collapsed or something has happened.
Wasn't it as big a moment for you guys?
No, I do not think that way. Okay. See, that's a very good moment for the investor, because you have raised the investor side. For investor, this was very involved step by the regulator, where they have come up with a very transparent mechanism, disclosure policy, and also on the payment part, they are making it very clear that this is how it has to happen. See, any industry, investors will be confused if the regulations are not clear. When the regulations are clear, they will be very super confident about it. Question could be whether the growth will remain the same way what it was earlier, or it will change, whether there will be stabilization period for next 6 months or 12 months before the growth again comes back. Those are the questions to be answered yet. But as far as the investors' confidence is concerned, I believe if 6 months back, 5 out of 10 people were getting confidence on P2P industry, now more people will be confident about it. The decision of investing or not, there could be completely different question. But confidence level will definitely grow with whatever new regulations.
Anisha, did you notice how many times are we using the word investor here, right?
Yeah,
Even though
that, right? But no,
we are using because you are using, and we understand.
And she's using because that's the topic.
But yes, I mean, ultimately that is what it comes down to, returns from the investor point of view, right? But let's talk about the regulator now. Yes, there is a lot of clarity, and the investors and the entire industry is very happy for the clarity that you've got in August 2024. But do you think it's a little too late, in the sense, weren't you guys looking forward to it for a long time? Why do you think RBI took so long to come up with the clarity on the matter? Is it a little too less, a little too late?
Possibly
surely a lot more than we would be expecting.
Yeah, exactly. It should have been over the period of 7 years, maybe every couple of years. There are some small set of changes, so that industry understands what direction they need to catch up with. right? In new technological world, technology will always grow faster than the responses which all reaction which you will get from the regulator. 7 years is a very long period. Lot of things will change. Say if we go back 7 years, let's say in 2015, how many people were transacting on UPI? Even if you will disburse money to borrower after 3 or 4 days, they will be very happy. I remember our initial set of borrowers. जब तीसरे चौथे दिन लोन का पेमेंट जाता था, बोलता अरे सर क्या बात है, बैंक से आने में तो इतने दिन लग जाते हैं. Today, where is the expectation? 2 घंटे में पैसा नहीं गया तो you will get a flood of email on the platform. Ask my CS team members if they are around. There will be thousands of email hitting our system. So the expectation has changed. If regulations are not changed, there will be reinterpretation of the regulation along with the change or availability in the technology, which has happened. Possibly, if every 2 or 3 years, there will be some small set of changes in the regulation, probably it will be able to catch up along with the technological and the market expectation. So, if you ask me, I would say if this change, some of these changes are implemented in 2021-22 and few more are implemented now, possibly could have been really good sense of direction to be given to the industry. Today, okay, we are digesting. It may take a few more days or a couple of months for the industry and the investors, but I think it will improve.
See, as regulated entities, right, our honest expectation is 3 C's: consistency, clarity, and probably more access to communication with them, right? So, honestly, we are very, very happy that this the chase has finally ended, right? And we have gotten clarity after a year, because there were a lot of speculations, reinterpretations, anxiety amongst the players, the stakeholders and all. At least now the rules of the game are clear. If they would have been made clear 5 years back, probably at the size and scale at which we are, it would have been much more easy to adapt to them, right? So, but it's good, it's better late than never.
Better late than never. Yeah, sure.
Just a quick pitch in. So compared to a lot of other investment products or lending products, and now and everybody knows what term to use. But this is a very involved business. Lending by itself is a very involved business. It's not like selling an investment product, debt investment, आपने debt mutual fund बेच दिया and then you've forgotten about.
Larger question to you, Achal. The overall interpretation or the creative interpretation, I think that's what the jobs of the startups and fintechs is, right? Do you think this will get curbed and this will kind of hamper the overall startup and entrepreneurial sentiment in the system?
Yeah, see, the job of we are innovators at heart, right? And the job of fintechs was to probably push the boundaries, but I think RBI has given a sure. So RBI has given a clear signal, right? Play it like a test match and not like a T20. Do innovation in a more balanced way. So we are all up for it, right? But see, like Bhavin said, we are toddlers, and the role of a parent is not to slap the kid when he's running or
pulled up for it if you do that.
for being naughty, right? We want to be nurtured and want that assurance from RBI. Like, see, there's when you are innovating something, there's some things which are bound to go right, there's some things which are bound to go wrong. But you can't give death sentence for being wrong. Otherwise, there will be an atmosphere of fear, and which will be counter intuitive for innovation, right? So, my only request would be to kind of play it like partners rather than like a teacher, right? And of course, are all up for balanced innovation, all up for playing by the rules, provided the rules are clear.
Yeah, and the RBI governor just day before yesterday did call for self-regulation. So I think that's something as well that you guys can take home. But just since we have time only for closing remarks, tell me whether I will see you guys next year as P2P platforms at GFF or not. Because yes, these are very difficult kind of regulations that have come, but Bhavin seems very confident that you'll be able to wade through this.
You will see me on 10th GFF on the same stage, probably in the larger room.
Wow, that's a very good one. I think that just gives me the best time to close this discussion. Thank you so much, everyone, for joining us today, and thanks so much for hearing us out.
Thank you so much, Anisha, and our esteemed panel. As much as we love to listen to this conversation, we have to continue with our next one. So thank you everybody for joining us up on stage and gracing GFF 2024 with this interesting immersive experience that we just witnessed. Calls for a picture perfect moment up here.